Did you know that the richest 1% now own nearly half of the world's wealth? This staggering disparity is reshaping global finance. The widening wealth gap is no longer a peripheral concern. It's a central force influencing economic policies and investment trends. Today, we'll explore how this profound economic divide is redefining global finance strategies and what that means for our collective future. First, let's define it. The wealth gap refers to the unequal distribution of assets and income among different segments of a population. Its drivers are complex, including globalization, which has created both immense opportunities and significant inequalities. Technological advancements, while boosting productivity, have often concentrated wealth in the hands of a few innovators and investors. Policy choices, from taxation to labor laws, also play a crucial role in either mitigating or exacerbating these disparities. And we cannot forget historical factors, like colonialism and systemic discrimination, whose legacies continue to shape economic outcomes today. Global data clearly shows this gap widening, creating urgent challenges for policymakers and financial institutions alike. The wealth gap profoundly alters investment patterns. The wealthy increasingly favor specific asset classes. This includes private equity, luxury goods, and alternative investments, seeking higher returns and diversification. Conversely, traditional public markets and small businesses often see reduced capital, impacting broader economic growth. Monetary policy faces new challenges. Central banks grapple with inflation and growth while avoiding exacerbating inequality. The effectiveness of interest rate changes in a highly unequal economy becomes a complex puzzle for economists. Fiscal policy responses are also evolving. Debates around wealth taxes, progressive taxation, and social safety nets intensify. Government spending priorities are shifting to address inequality or stimulate broad-based growth, reflecting societal pressures. New financial products and services are emerging. Fintech is catering to underserved populations with microfinance and digital payments. The rise of impact investing and ESG funds, driven by social awareness, is also a direct response to these disparities. Geopolitical implications are significant. Wealth disparities within and between nations influence international trade and power dynamics. The potential for social unrest and political instability, fueled by inequality, directly impacts global financial markets. Let's look at some case studies. In certain regions, the wealth gap has significantly altered financial approaches. For example, the rise of populist movements in some nations is directly linked to economic grievances and inequality. This has led to specific policy implementations, such as increased social spending or protectionist trade measures. We also see innovative strategies adopted by financial institutions and governments to bridge this divide. These include initiatives for financial literacy, access to credit for small businesses, and targeted development programs. In summary, the wealth gap is fundamentally reshaping global finance, influencing investment, monetary, and fiscal policies. It's driving the emergence of new financial products and services, and has profound geopolitical implications. Addressing wealth inequality is crucial for sustainable financial stability and a more equitable global economy. What strategies do you think are most effective in bridging the wealth gap? Share your thoughts in the comments below.